Hi to IPO subscribers. Welcome to eaglelive.ai. Today let us review IPO on Mother Knit Limited. Here we go on IPO review. As we start the review of any IPO with the fundamental analysis, here is the financial analysis of the company. So this is the AI-powered software generated analysis, and as per information given to the software, this company has been categorized as an unhealthy company. Let us see what are the financial weaknesses that are there to classify this company as an unhealthy company. So debt equity ratio, DSCR, everything is a gearing is also weak. Debt to assets ratio 0.7. It should be less than 0.6. Debt against assets must be less than 0.66. It is more than, it's 0.72. The other negative is net worth to assets. Net worth must be more than 0.34. It is 0.27. So this affects the solvency. In other words, I should say sustainability of the company. Debt burden is over. Debt burden over means servicing the debt is a little bit problem. So anyway, so company has been classified as an unhealthy company. Coming to liquidity position, okay, current ratio is 1.48, but quick ratio is 0.77. 0.77 means maybe they have good amount of inventory levels in their current assets. That is one reason. And coming to operational efficiency, inventory turnover moderate, gross margin 30.38. Of course, it's depending on the industry. And receivable turnover, in general, we expect more than 7.8, it is 4.85. Trade payable, in general, we expect more than 8, it is 1.24. Okay. Working capital turnover 4.67. Okay. So financial irregularities, no financial irregularities have been identified. So coming to profitability, EBITDA is 25.77, EBIT is 23.35, PBT is 16.58, PAT is 12.35, cash profit 114.78, EPS 9.2, EBITDA margin 13.23, net profit margin 6.34, very less. ROC is 31.6, ROE is 30.98. Coming to book value 31.87. Okay. And the cash flows from operating activities are 4.43 and net cash flow surplus for 1.86 positive plus. So coming to market values, the cap price is 100 rupees of IPO, and based on that, price earning ratio is coming at 10.86, very good, and price to book value is 3.13. So it should be less than 3. The 3.3 is one okay. Let us see projected valuations, then we can take it, we can take an opinion. Growth indicators, EPS growth is a little bit less, otherwise, and sustainable growth also 11.96 as against actually expected is more than 25. So this is the financial analysis and status of the company. Now let us go on IPO review. Yes, here is the IPO review. Mother Knit Crafts, sorry, the beginning I will not give the full name. Mother Knit Crafts Limited, reasonable valuation, but our financial risks worth taking. Is a question mark. Mother Knitcraft is a Ludhiana-based textile manufacturer with an integral and to cloth manufacturing model, producing fabrics, blankets, winter textiles, and garments. The company has been in the textile business since 2013, almost 13 years standing period, and operates on ISO 9001 2015 certified age facility. Business overview. Established in 1997, commercial operations began in 2013. Manufactures fabrics, blankets, winter textiles, and garments. Integrated manufacturing covering knitting, dyeing, printing, brushing, polishing, seeding, stendering, and finishing. Manufacturing facility located in Ludhiana, Punjab, a major textile hub. Use machinery sourced from Korea, Taiwan, and China. And capacity reportedly increased significantly, supporting future growth. Exposure to consumer, institutional, and industrial textile demand. IPO and final fund utilization. Price band on 95 to 100, fresh issue approximately 53.27 crore based on the issue information provided, major utilization. 20.85 crores debt repayment, 15.92 crores working capital, 3.68 crores solar panel capex, that is capital expenditure, balance general corporate purpose and issue expenses. Valuation, the key investor question at 100 rupees per share, EPS 9 rupees 20. Of course, as per the figures provided, PE to 10.86, PB 3.07, and stated projected PE 9.41, stated projected PE 1.97. Okay, our valuation view, reasonable valuation, but not a deep value IPO, because the original price to book value is more than 3, no? So the 10.9 pre-present ratio appears reasonable at the upper price band. However, investors should be cautious about assigning full value to the very high projected earning CGR. The 3.07 PB also does not represent an obvious bargain, particularly when financial health and governance concerns are considered. So debt level is very high, that's the problem. So our view, moderately attractive. Valuation looks reasonable, but financial quality must justify the price. Key risks, financial health concerns, highly competitive textile industry, working capital and customer payment risks, history of delays, defaults and statutory payments, related party business in the same sector may create governance conflict of interest concern. So, sustainability of exceptionally high earnings growth needs to be verified. Market sentiment. The IPO is scheduled to open on August 24th and with a current price band of 95 to 100. Current gray market indicates are showing zero GMP, suggesting neutral, cautious sentiment ahead of the issue, rather than strong speculative enthusiasm. Actual subscription data is not available because the issue has not opened. Market sentiment neutral, cautious. Final investor view: business positive, growth potential positive, valuation reasonable, financial health a concern, governance risk concern, and market sentiment neutral. Conclusion: Mother Knitcraft offers a reasonable entry valuation, but the financial health and governance risk prevent it from being a clear-cut value opportunity. Investor takeaway: cautious subscribe, suitable mainly for risk-tolerant investors. Key question for investors: is the reasonable P enough compensation for the company's financial and governance risk? It cannot be. So my view, no, not enough compensation for a cautious investor. Sorry, at 10.9 price earning ratio is reasonable and prevents the IPO from looking expensive. However, reasonable valuation alone does not make an IPO attractive when there are concerns around financial quality, statutory payment history. In general, statutory payment history means so when they don't pay the statutory payments in time, when they have some cash problems. That is the reason. Some health issues also are there. That is the reason debt is very high. So that is the reason why one should think of price. Working capital requirements and governance related party risks. And so the argument should be the valuation is reasonable, but not cheap enough to provide a sufficient margin of safety against the identified financial and governance risks. Final recommendation: cautious subscribe only for risk-tolerant investors. I would not call it a strong subscribe or deep value IPO. The PE is attractive enough to keep the IPO on radar, but the risk profile requires meaningful valuation cushion. Key investor question: is 10.9 PE cheap enough to compensate for the financial and governance risks? Our answer: not enough margin of safety. Verdict: cautious subscribe. As always, investment decision should be based on your own financial goals and risk tolerance. Thank you very much for watching. If you found this analysis useful, please like the video, subscribe to the channel, and stay connected for more detailed IPO and stock market research. Thank you very much.